While you're watching this, institutional money is paying $106 per ounce in Shanghai. The same silver trading at $95 in New York, an $11 premium. David Bush, chartered financial analyst, calls it unprecedented market distortion. Western vaults, draining to the east, solar panels, AI infrastructure, technology production, creating a structural deficit. The business community hasn't priced in yet. The Fed, locked between 2.8% inflation and political pressure. Greenland's minerals, Venezuela's oil, resource competition intensifying. But here's what they're not telling you. The physical shortage, already triggering the repricing, and if you're not positioned before price discovery completes, welcome to Cash Tail. Now, before we proceed with this critical analysis, I have a simple request for those of you who've built businesses, managed investments, and understand that real intelligence requires commitment. If you appreciate research that respects your time and experience, hit that subscribe button. We're not here for entertainment. We're here because you deserve economic briefings that treat you like the decision maker you are. And tell me, where are you watching this from today? New York, London, Singapore, Mumbai? Drop your location in the comments. Because this silver repricing, it's not regional, it's global. Now, let's examine exactly what's happening in these markets. The global silver market is experiencing something financial professionals have rarely witnessed in their careers, a price gap that defies conventional market logic. In New York, silver trades at $95 per ounce on paper contracts. In Shanghai, the same physical metal commands $106 to $107, an $11 premium. David Bush sits in his office at Trajan Wealth, reviewing the data with the careful precision expected from a chartered financial analyst. He has spent decades translating complex market dynamics into actionable strategies for serious investors. This silver distortion, it troubles him, not because markets occasionally show pricing inefficiencies. They do. But because this gap is widening, not closing. The fundamental principle of arbitrage suggests that when an asset trades at different prices in different locations, traders should buy where it's cheap and sell where it's expensive. The price gap should disappear within days, sometimes hours. That is not happening with silver. Instead, physical metal continues flowing from Western vaults to Eastern accumulation centers. The COMEX warehouses in New York are draining systematically. Month after month, the inventory reports show the same pattern. Silver leaving, silver moving to China. Bush explains it to his clients with characteristic calm. There are two forces operating simultaneously in this market, he tells them. First, the flight to quality. Geopolitical uncertainty drives investors towards safe haven assets. When headlines scream about conflicts, trade wars, and monetary instability, institutional money seeks protection. Gold receives most of the attention. But silver? Silver offers the same monetary characteristics at a fraction of the price. Second, industrial demand is accelerating beyond forecasts. Solar panel manufacturing requires silver. Every panel needs it for electrical conductivity. The global push toward renewable energy is not slowing down, it is intensifying. AI infrastructure requires silver. Data centers, semiconductor production, advanced computing systems, all depend on silver's unique properties as the most conductive metal on Earth. Technology production requires silver. Electric vehicles, 5G networks, medical devices. The industrial consumption list grows longer each quarter. Bush reviews the supply-demand fundamentals. The mining industry is not keeping pace. New silver mine development takes years. Existing mines face declining ore grades. Recycling provides some supply, but not enough to close the deficit. The business community watching these developments faces a choice. Some dismiss the price gap as temporary market friction. They maintain conventional assumptions. Paper markets will eventually align with physical markets, they say. Wait and see. Others recognize what institutional accumulation patterns typically signal. When professional money pays an $11 premium for physical delivery, that is not market inefficiency. That is informed positioning. Bush has seen this movie before in other commodities, not with this exact script, but with similar themes. When sophisticated investors accept significant premiums for physical assets over paper contracts, they are expressing a view about future price discovery. They are saying the paper price is wrong. They are saying physical scarcity will force repricing. They are saying better to pay the premium now than chase the price later. The silver market operates on two levels that are disconnecting. The paper market in New York trades contracts, financial instruments, promises of future delivery. Leverage allows massive position taking with minimal capital. Prices move on sentiment, technical patterns, and short-term trading flows. The physical market in Shanghai trades metal, actual bars, real delivery, no leverage. Prices reflect what buyers will pay and sellers will accept for tangible assets they can hold. When these two markets show an $11 gap, something fundamental is breaking. Bush explains to his investment committee that silver occupies a unique position in global markets. It functions as both a monetary asset and a critical industrial commodity. Gold is primarily monetary. Copper is primarily industrial. Silver is both. This dual nature creates demand dynamics that are structuring a deficit the market has not fully priced. The monetary demand provides a floor. The industrial demand provides acceleration. And the supply? The supply is not responding fast enough. Western investors checking their brokerage accounts see silver at $95 and make decisions based on that number. Eastern institutions taking physical delivery pay $106 and make decisions based on actual market reality. One of these groups is operating with accurate information. One is operating with paper fiction. The question facing the business community is simple. Which market are you trusting? The one showing you comfortable numbers, or the one where real metal actually changes hands? Because that $11 gap, it is telling a story, and institutional money is listening. Something shifted in global power dynamics during the final months of 2024. The shift was not announced in press conferences, it was not debated in congressional hearings, but financial analysts like David Bush noticed it immediately in the resource markets. The United States began positioning for something larger than trade negotiations. They began positioning for hemispheric resource dominance. Venezuela sits on the largest proven oil reserves in the world, larger than Saudi Arabia, larger than Russia. For decades, this oil remained largely inaccessible to American refineries due to sanctions and political hostility. Then, the calculus changed. Suddenly, there were discussions, diplomatic movements, strategic conversations about normalizing relations. Not because of human rights improvements, not because of democratic reforms, because of the oil, and more importantly, because of geography. Bush studies the map with his investment team. Venezuela is close, remarkably close to the United States. Its oil can reach Gulf Coast refineries without crossing oceans, without navigating through geopolitically hostile waters. The transportation costs are minimal. The strategic vulnerability is reduced. But oil is only part of the equation. Greenland emerged in headlines with surprising frequency. The president-elect spoke about it repeatedly. Purchasing Greenland, controlling Greenland, not for tourism, not for military bases alone, for the minerals beneath the ice. Greenland holds rare earth deposits that American technology companies desperately need. The AI infrastructure boom requires these materials. Semiconductor manufacturing depends on them. Advanced battery production cannot proceed without them. China currently dominates rare earth processing. They control approximately 80% of global refining capacity. This creates a strategic vulnerability that keeps defense planners awake at night. If China restricts rare earth exports, American technology production grinds toward paralysis. Greenland offers an alternative, a Western Hemisphere alternative, under potential American influence. Then there is Panama. The Panama Canal handles approximately 5% of global maritime trade. More importantly, it provides the shortest route between the Atlantic and Pacific Oceans for Western Hemisphere shipping. Chinese companies have been increasing their presence around the canal. Port operations, logistics facilities, infrastructure investments. American strategic analysts view this with growing concern. Control the canal, and you control a critical artery of hemispheric commerce. Bush explains the pattern to his clients who trade in commodity markets. These are not isolated events, he tells them. These are coordinated movements in a larger strategy. The strategy has a name, though few officials use it publicly. The Monroe Doctrine 2.0. The original Monroe Doctrine, declared in 1823, established that European powers should not interfere in the Western Hemisphere. America would view such interference as hostile acts. The modern version adds a new element. Eastern powers, specifically China and Russia, should not control critical resources or infrastructure in the Western Hemisphere. Venezuela provides energy security. Greenland provides mineral security. Panama provides logistics security. Together, they form a resource perimeter. But here is what most casual observers miss. This resource competition directly impacts precious metals markets. When China sees American moves to secure hemispheric resources, they respond by accelerating their own resource security measures. And their primary resource security measure is physical metal accumulation. Gold reserves increase in Chinese central bank vaults. Month after month, the official reports show additions. But those are just the official reports. Unofficial accumulation likely runs much higher. Silver reserves build in Shanghai warehouses. The physical metal flowing from COMEX vaults in Part 1, much of it ends up in Chinese institutional hands. The Russians follow similar patterns. Sanctions taught them that Western financial systems can be weaponized. Dollar-denominated assets can be frozen. Swift access can be revoked. But physical gold and silver? Those cannot be frozen by executive order. They cannot be sanctioned away. They represent true financial sovereignty. So the geopolitical competition creates a feedback loop. America secures Western Hemisphere resources. China and Russia accelerate Eastern precious metals accumulation, which drains Western vaults, which increases the physical shortage, which widens the price premium documented in Shanghai markets. Business leaders watching these developments must understand the connection. The $11 silver premium is not just about industrial demand. It is about geopolitical positioning. It is about resource nationalism in an increasingly multipolar world. David Bush reviews commodity flow data with his team. Shipping patterns tell stories that official statements obscure. Where is silver moving? From west to east? Where is gold accumulating? In non-Western central banks. The business community faces a strategic question. In a world fragmenting into resource blocks, which assets provide genuine security? Paper contracts denominated in currencies that can be weaponized? Or physical metals that have retained value across every empire, every currency collapse, every geopolitical realignment in human history? Venezuela's oil, Greenland's minerals, and Panama's canal are not abstract geopolitical topics. They are pieces in a resource competition that is repricing commodity markets right now. And silver, sitting at the intersection of monetary value and industrial necessity, is repricing faster than most investors realize. The premium in Shanghai is not noise, it is signal. And institutional money is positioning accordingly. January 2026 brought economic data that should have settled the debate. GDP revised upward to 4.4%, unemployment hovering near historic lows, corporate earnings showing resilience. By traditional metrics, the American economy was performing exceptionally well. Yet David Bush reviewed these same numbers with growing unease, not because the economy was weak, but because the Federal Reserve was trapped. The October and November inflation reports arrived simultaneously in January due to the government shutdown delays. Economists and strategists had been piecing together estimates from alternative data sources for weeks. When the official numbers finally published, they confirmed what Bush already suspected. Core PCE inflation remained stubbornly anchored at 2.8%. The Federal Reserve's target is 2.0%. That 0.8% gap represents the battleground where monetary policy dies. Bush has witnessed multiple Fed cycles during his career as a chartered financial analyst. He has seen aggressive tightening. He has seen emergency rate cuts. He has navigated clients through the 2008 financial crisis, the COVID pandemic response, and the subsequent inflation surge. But this environment feels different. The Fed typically has clear options when facing economic challenges. Economy overheating, raise rates, recession threatening, cut rates, financial crisis emerging, provide liquidity. Now, every option carries unacceptable consequences. Cut rates, while inflation sits at 2.8%, risk reigniting price acceleration just as it appeared contained. Raise rates while political pressure intensifies, risk economic slowdown in an election aftermath where the administration demands growth. Hold steady, watch market volatility increase as uncertainty compounds. The Fed chair sits in this impossible position, knowing that every decision will be criticized, every action will create winners and losers, every statement will be parsed for hidden meanings. Bush explains this dynamic to his investment committee using a metaphor. The Fed is trying to land an airplane in a crosswind. Too much correction in one direction. They overshoot. Too little. They miss the runway entirely. And the markets are watching every adjustment with microscopic attention. The interest rate futures market currently prices in one potential rate cut in 2026. Maybe. Possibly, depending on data. Another potential cut in 2027, perhaps. These probabilities fluctuate daily and sometimes hourly. A strong employment report, probability of cuts drops. A weak retail sales numbers, probability increases. But here's the critical insight that separates professional analysis from casual observation. The Fed cannot cut rates meaningfully while inflation remains above target. Their credibility depends on achieving the 2% goal. Their entire institutional legitimacy rests on price stability. If they abandon that target because of political pressure or market volatility, they undermine decades of carefully constructed central bank independence. Yet they also cannot ignore political reality. The new administration wants lower rates. They want cheaper borrowing costs. They want fuel for economic expansion. The tension between institutional mandate and political pressure creates policy paralysis. And policy paralysis creates market uncertainty. And market uncertainty drives capital towards safe haven assets. Gold benefits from this dynamic. Silver benefits even more because it combines safe haven characteristics with industrial demand growth. Bush watches the precious metals markets respond to each Fed statement. When officials sound hawkish, gold and silver pause briefly, then resume climbing. When officials sound dovish, metals accelerate immediately. The market is learning that regardless of Fed rhetoric, inflation above target means precious metals maintain their bid. But there is another layer to this situation that fewer analysts are discussing publicly. The last mile to 2% inflation is proving structurally difficult, not because of temporary supply chain disruptions, not because of energy price spikes that will soon reverse, but because certain inflationary forces are embedded in the economic system. Housing costs remain elevated. Shelter represents a massive component of inflation calculations. Rents are not declining meaningfully. Home prices continue rising in most markets. Service sector wages show stickiness. Workers who received wage increases during the labor shortage are not accepting cuts. Businesses passing these costs to consumers face limited resistance because employment remains strong. Healthcare costs trend upward. Insurance premiums increase. Medical services become more expensive. This inflation component rarely reverses. Education costs follow similar patterns. Tuition rises. Childcare becomes more costly. These increases persist regardless of Fed policy. Bush reviews the composition of the inflation basket with his team. Even if goods prices moderate, services inflation can keep the overall number elevated, and the Fed has limited tools to combat services inflation without triggering a recession. This is why the precious metals market is repricing. Institutional investors are not betting on immediate Fed rate cuts. They are positioning for a prolonged period where inflation remains above target. Rates stay higher than the market wants, and real yields on bonds remain suppressed. In that environment, metals outperform. The headlines continue generating volatility. Venezuela negotiations, Greenland discussions, European tariff threats, Ukraine conflict developments. Each headline triggers market reactions. Stocks sell off, then recover, then sell off again. Bush counsels his clients with consistent messaging. Stay patient, stay invested. Do not make emotional decisions based on two-day market movements. Because while headlines create noise, fundamentals create direction, and the fundamental reality is this. The Federal Reserve cannot solve its inflation problem quickly. They cannot cut rates aggressively. They cannot restore the zero-rate environment that markets enjoyed for years. The era of free money has ended, and in the new era, hard assets regain relevance. Silver's $11 premium in Shanghai is not disconnected from Fed policy paralysis. It is directly connected. Eastern institutions buying physical metal at premium prices understand what Western paper traders are missing. Inflation persistence is not temporary, it is structural, and structural inflation requires structural portfolio adjustments. The question for the business community is whether they recognize this shift before price discovery completes, or after the repricing has already occurred. The data is on the table. Physical silver trading at an $11 premium over paper contracts. Western vaults systematically draining to Eastern accumulation centers. Geopolitical resource competition intensifying across the Western Hemisphere. Federal Reserve locked in policy paralysis with inflation stuck above target. Now comes the critical question that separates analysis from action. What does the business community do with this information? David Bush has spent his career translating market dynamics into actionable strategies for serious investors. He has guided clients through multiple crisis periods, through technology bubbles, through housing crashes, through pandemic disruptions. His guidance now carries the weight of pattern recognition earned over decades. Stay patient. Stay invested. Stay diversified. These three principles sound simple, almost too simple for the complexity of current markets. But Bush explains why they matter more now than ever before. The headline-driven volatility creates an illusion of required action. Venezuela negotiations break down. Markets sell off. Investors panic. They liquidate positions. Then, within 48 hours, agreements are reached. Markets recover. The panic sellers have locked in losses. This pattern has repeated multiple times already in early 2026. Professional investors recognize these headline reactions as noise, temporary disruptions and longer-term trends, opportunities for disciplined positioning rather than reasons for emotional exits. But amateur investors see each headline as a potential catastrophe requiring immediate response. The difference in outcomes over time is dramatic. Bush reviews the actual data with his team. The market sold off significantly during the Greenland controversy, then recovered above previous levels within 2 days. Investors who sold during the panic missed the recovery entirely. They crystallized losses at the worst possible moment. They violated the fundamental principle of buying low and selling high by doing precisely the opposite. This is why market timing fails for individual investors even in calm environments. In the current headline-driven chaos, it becomes nearly impossible. You would need to correctly predict the initial headline impact, then correctly predict the resolution timeline, then execute trades at precise moments while managing emotions under pressure. Even professional traders with sophisticated systems struggle with this level of complexity. For business owners and entrepreneurs building long-term wealth, it represents a path to destruction rather than prosperity. So the first strategic principle is patience. But patience does not mean passivity. It means maintaining positions in assets with sound fundamentals while short-term volatility plays out. Silver presents exactly this kind of opportunity. The fundamentals are clear. Industrial demand is accelerating. Solar panel production requires silver. AI infrastructure requires silver. Technology manufacturing requires silver. These are not temporary trends that will reverse next quarter. These are structural shifts in how the global economy functions. Meanwhile, mining supply is not keeping pace. New mine development takes years. Existing mines face declining ore grades. Recycling provides some offset, but cannot close the deficit. Supply constrained, demand accelerating. Price distortion widening between paper and physical markets. This is the classic setup that commodity investors dream about finding, yet many Western investors remain focused on paper contract prices, while Eastern institutions quietly accumulate physical metal at significant premiums. Bush explains the second strategic principle, diversification, not diversification for its own sake, but intelligent allocation across assets that perform in different environments. Large-cap growth technology stocks provide exposure to AI infrastructure development and digital transformation. These companies are building the future economy. They deserve portfolio allocation. But technology stocks also carry valuation risk and volatility during headline-driven sell-offs. Value-oriented dividend-paying stocks provide income generation and downside cushioning. They trade at more reasonable price-to-earnings multiples. They return cash to shareholders regardless of market sentiment. These reduce portfolio volatility while maintaining equity exposure. Precious metals provide inflation protection and geopolitical risk hedging. They perform when traditional financial assets face pressure from monetary instability or resource competition. Silver specifically offers the unique combination of monetary characteristics and industrial demand growth. This diversified approach allows investors to participate in economic growth while protecting against the various risks that could disrupt that growth. No single asset class solves every problem, but a thoughtful combination addresses multiple scenarios. The third principle is maintaining investment discipline. American exceptionalism is not blind patriotism. It is recognition that the United States continues to lead in technological innovation, entrepreneurial energy, and economic dynamism. Despite political chaos, despite headlines screaming crisis, despite uncertainty about tariffs and trade wars, the underlying economy continues generating wealth. Companies continue innovating. Entrepreneurs continue building. Investors continue finding opportunities. Bush remains a firm believer that within all the current noise, systematic opportunities exist for prepared investors. But preparation requires understanding what is actually happening versus what headlines suggest is happening. The silver market provides a perfect example. Headlines discuss price movements. Technical traders debate chart patterns. Social media posts hype moonshot predictions. None of that matters compared to the fundamental reality. Physical metal is scarce. Industrial demand is structural. Eastern institutions are accumulating. The paper-physical price gap signals future repricing. Investors who position in physical silver now are not speculating on price movements. They are recognizing a market distortion that will eventually correct. And when corrections happen in commodity markets, they tend to happen quickly. The $11 premium in Shanghai is not stable. It is widening. Each month, the gap grows larger as physical shortage intensifies. At some point, paper contract holders will demand physical delivery. COMEX will face settlement pressure. Price discovery will shift from paper trading to physical availability. When that moment arrives, the repricing will not be gradual. It will be violent. And investors who waited to validate the move before positioning will chase prices that have already adjusted. This is the window that professional money recognizes, the window before price discovery completes. The window when physical metal is still available at premiums that seem high now but will seem modest in retrospect. Bush has seen this pattern in other commodity markets. The investors who profit substantially are not the ones who wait for confirmation. They are the ones who recognize structural imbalances early and position accordingly. The business community now has the framework. Silver market distortion documented, geopolitical resource competition explained, Federal Reserve constraints and outlined, strategic positioning principles established. What remains is individual execution. This analysis functions as economic intelligence for serious decision makers, not entertainment for casual observers. The difference between those two groups will become apparent in the months ahead. When silver completes its repricing, and the premium that exists today in Shanghai becomes the baseline price throughout global markets, the question is not whether this repricing happens. The question is whether you positioned before it occurred, or spent your time waiting for certainty that only arrives after opportunity has passed.